Welcome to today's special explainer, where we're going to totally bypass all that internet noise and uncover the real, hidden dominoes that caused today's massive global market crash. Seriously, if you opened your portfolio today and just saw a terrifying sea of red, I promise you, you're absolutely not alone. But look, what you're hearing on social media, it's just not the whole story. So today, we're going to break down exactly what happened, step by step, and much more importantly, what you should actually do about it right now. Okay, let's dive right in. So, why did the global market literally crash everywhere today? With Bitcoin dropping 3.5%, the Nifty down 1%, and international gold falling roughly 2% all within the last 24 hours, you're probably sitting there wondering what catastrophic event just triggered this massive wipeout across all your portfolios. I mean, normally when stocks take a dive, safe havens like gold are supposed to go up, right? But today, everything took a massive hit. So what on earth is actually going on?
Well, if you log on to Twitter or flip on the news right now, you're going to see a ton of panic. A lot of people on the internet are freaking out and blaming the looming threat of an Iran war, jumping straight to conclusions about some imminent global conflict. But here's the thing. The data tells a completely different story. And we don't want to operate on fear here. We want to operate on facts.
Think about it. If a major war in the Middle East was actually imminent, Brent crude oil prices would be absolutely skyrocketing. That is literally always the very first indicator. But because the oil trend line is actually falling right now, we know for a fact that war isn't the primary trigger for this specific crash. As long as that crude oil trend line remains intact and points downward, this immediate war panic, it's just a distraction.
So, if it's not war, what is it? Let's look at domino number 1, the trigger, the Asian market domino.
To actually solve this mystery, we have to look at the very first domino that violently tipped over. And the real panic? It started in South Korea, with their benchmark index, the Kospi. Basically, think of the Kospi just like the S&P 500 in the US or the Nifty in India. It suffered such severe and tense selling today that multiple circuit breakers were triggered throughout the trading session. Now, if you don't know, a circuit breaker is essentially an emergency brake pulled by the exchange when prices are free-falling way too fast. They opened it back up and boom, it tripped again. It was just relentless selling.
And the sheer scale of the sell-off was just staggering. The Kospi plummeted a terrifying 10% in a single day. That kind of drop is historic. And it obviously didn't happen in a vacuum. This massive, localized sell-off pulled the Japanese Nikkei down by 3.5% and Hong Kong's Hang Seng down by 1.8%. The entire Asian region was just drowning in red today.
However, before you panic and assume the sky is completely falling, we absolutely have to contextualize this data. Yes, a 10% daily drop is terrifying, but the Kospi is still up an astonishing 172% over the last year. People tend to look at the daily drop and immediately scream crash, but they totally forget to zoom out. This wasn't an apocalypse, guys. It was a massive, aggressive round of profit booking after a gigantic bull run. Which brings us to domino number 2, the underlying vulnerability. The AI bubble burst.
See, we have this fundamental vulnerability in the global markets right now, and it's heavily centered around technology. We're witnessing the beginnings of the AI bubble finally letting out some serious steam. Take Google's Alphabet stock, for instance. It took a 5% hit today. But again, look at the context here. This drop happened simply because investors are finally booking their profits after a massive 110% rally. The tech sector, semiconductors, AI companies, they've all run up so incredibly fast and high, especially in the US markets, that a correction was honestly inevitable. It's entirely normal market behavior.
Now, a really important question comes up. If investors are booking all these massive profits and cashing out, where is all that money actually going, right? The millions being pulled out of tech stocks, semiconductors, and crypto aren't just magically disappearing into thin air. They're being strategically relocated by smart money.
And that reveals domino number 3, the hidden force, the bond yield magnet.
This right here is the invisible gravity shifting the entire financial world. Government bond yields are currently acting like a giant, irresistible magnet. They're literally pulling capital away from volatile, risky markets by offering incredibly attractive, guaranteed returns. When inflation runs hot, central banks raise their rates, and suddenly the government is willing to pay you a very handsome guaranteed percentage just to hold your money.
To really grasp the scale of this magnetic pull, just consider this unprecedented event. Even Japan, a country that is famous for literally having zero or even negative interest rates, finally hiked its interest rates for the first time in 31 years. I mean, that is a generational shift. It signals to the entire world that the era of free money is firmly over, and guaranteed yield is back on the menu.
So, when inflation forces governments to offer high, guaranteed returns on super safe instruments like fixed deposits or government bonds, rational investors are faced with an easy choice. Why on earth would you risk your capital in highly volatile assets like Bitcoin or completely overvalued AI stocks when you can just lock in a safe, guaranteed high-yield return? The answer is simple. You wouldn't. They immediately drain their funds from risky assets to lock in that sweet safety.
Which leads us with domino number 4, the result: global capital reallocation.
This entire domino effect, from the Asian profit booking to the tech sell-offs to the rising interest rates, it all culminates in a massive structural shift. You are literally watching global capital reallocation play out in real time. Capital is rapidly flowing out of overvalued equities and straight into foreign currency deposits. Smart money is specifically seeking the rock-solid stability of the US dollar, the Australian dollar, and UAE dirhams. Some governments are even incentivizing non-resident citizens to bring their foreign currency in and lock it into high-yield fixed deposits. So money is literally draining from the stock market bucket and pouring directly into the safe haven currency bucket.
All right, Part 5. Actionable advice. What investors should do.
Now that you understand the actual mechanics behind the crash, and you know it's driven by yield shifts and profit booking rather than, the end of the world, here is exactly how you should handle your personal portfolio. I cannot stress this enough. Despite the terrifying sea of red across global markets right now, you absolutely must not stop your systematic investment plans. For instance, Indian market valuations are actually improving as a result of this dip. The absolute worst thing you could possibly do right now is panic, hit the stop button on your SIPs, and completely miss out on acquiring assets at these newly discounted prices.
Think of this downward volatility not as an apocalypse, but as the market clearing out all the excess froth to build a really solid foundation for its next upward rocket launch. Markets don't just go straight up forever. They have to breathe out before they can breathe in again. Right now, the market is simply making space to go higher.
So here's your game plan. First, remember you haven't married your stocks. You can just continue accumulating quietly on the dips. Second, if you happen to be an active trader, remember that you can profit from downward momentum too. You can consider short-selling real-world assets using platforms like Delta Exchange. And third, if you're completely new to shorting, please don't risk your own capital immediately. Use platforms that offer demo trading, like a $1,000 demo account, to really hone your skills safely while the market is this volatile. In fact, if you are actively trading real-world assets like gold and silver, platforms like Delta Exchange have just slashed their trading fees down to an incredibly low 0.01%. I mean, that is roughly 5 times cheaper than standard exchanges. It makes active portfolio management, whether you're hedging or shorting, highly accessible and super cost-effective right now.
As we watch central banks globally manipulate these massive economic magnets, I want to leave you with a really crucial question to ponder for our next explainer. We talk a lot about interest rates, but what exactly happens to your wealth, your loans, and your investments when a central bank, like the Reserve Bank of India, decides to change its repo rate? Think about how that connects to absolutely everything we just learned today. Thanks so much for joining me. Keep learning, stay focused, and I'll see you in the next explainer.